By now you may have heard that BCE is planning to acquire Ziply Fiber. It's an internet provider based in the Pacific Northwest in the United States. The deal is worth $5 billion and it's a big move for BCE because it suggests the company is going to pursue more growth opportunities in the US because Ziply Fiber is looking at expanding into more markets. So while that might seem like it's a good move for BCE, in the long term, this is primarily a dividend stock for a lot of investors. And the bad news was the company also said that it's not going to be increasing its dividend next year. And for years, investors have become accustomed to that dividend growth. So not great news for BCE stock in that sense. And it's resulted in a sizable sell-off. The stock's not just at a 52-week low, but it hasn't been this low in more than a decade. But what may surprise you is the fact that BCE was supposedly rumored to be involved in a much bigger deal, and that's to acquire Frontier. So Verizon recently went through with a deal to acquire Frontier Communications for $9.6 billion. And Frontier investors actually thought that that was too low. Since then, it's progressed, and it looks like the deal is going to go through. But what's interesting about this is the Wall Street Journal says that the runner-up for this was none other than Canadian telecom company BCE. So although it went with Ziply Fiber at $5 billion, it does suggest that the company was willing to spend a whole lot more, close to maybe 10 billion USD. So it gives you a bit of an insight that maybe BCE is planning to be a whole lot more aggressive. While $5 billion fit into its budget, it obviously was in the running to buy Frontier. Although it wasn't willing to spend as much as Verizon did, it's still a significant move. Frontier, after all, is a much larger company than Ziply. So Ziply is not a publicly traded company, but estimates are that it generates around $444 million per year. Frontier, by comparison, has generated around $5.8 billion over the trailing 12 months. And if we look at Verizon's investor presentation when talking about this, you can see that Frontier, it's much bigger. It's actually not in the Pacific Northwest. It's in a whole lot of other markets. So Frontier is a big company for Verizon to expand its network across the US. So if BCE was targeting this type of a company with this type of position in the US market, that kind of tells you that this is going to be that maybe BCE is thinking about a whole lot more growth than just the Pacific Northwest. So what does that mean for investors? So what I would suggest is that don't get too comfortable with the dividend, because odds are the company is going to cut that dividend. If its ambitions really are to go that deep into the US, that they were considering Frontier and they were considering the East Coast, California, all those states around the country, then BCE isn't going to be content probably with just focusing on the Pacific Northwest. It obviously has far larger ambitions than that. And with the dividend paying close to, I think, around 10%, more than 10% actually now due to that sell-off, there's definitely a justification for management to cut that payout and, suggest that they can get by with a much lower yield. Verizon, for example, yields around 6%, much lower than BCE. So there could be a lot of reasoning as to why BCE might make sense to cut that dividend, take that money, pump it into Ziply Fiber to expand its position in the US market. Because, if those rumors are true that BCE was looking to buy Frontier, that gives you some insight into what the company is thinking and what its growth ambitions might be. So that might be bad news if you're in it primarily for the dividend, but as a growth play, BCE could be a bit of an underrated buy right now because it's trading at more than a 10-year low at this point. And so if this proves to be a good move for the company in terms of growth, there could be a whole lot more upside for the stock to rebound and to become a whole lot more valuable. So overall, I still think BCE is not a bad buy at this rate just because its valuation is so low. And even if it cut the dividend, you'd still be getting a great payout. And on the flip side, it could make for an underrated growth stock, because if it's investing money into Ziply and that turns out to pay off really well for the company, then there could be a lot of room for BCE stock to climb a whole lot higher than where it is now. So it's a bit of a risky play in the short term, but I think in the long run, it should be able to bounce back from this. It's just burned a lot of dividend investors in the process, but I think if you're willing to be patient, I think it could be a good buy for the long haul.